We're going to pick up chapter 18 with measuring profit. Why do we want to measure profit? Well, profit's the whole reason we get up and go to work every morning, right? After all, if we're not going to measure profits, we might as well be a not-for-profit entity. But because we are incentivized by profit, we of course want to measure that. Now, there are a couple of ways that we can measure profit, and it depends really on the purpose of that measurement. The first is called absorption costing, and this is something that is required for GAAP accounting. It's what we use to prepare our financial statements that we are going to give to the bank or our investors. And what we do is we take obviously the direct costs and assign those to the unit products, but we also then apportion the overhead to each individual product as well, so that all of the overhead costs can be ultimately apportioned to a product. So again, not particularly useful for decision making, but from a purist standpoint, it gives a more accurate example, not accurate example, but representation of gross profits and operating income. We're going to look at an example using similar numbers using not only the absorption costing, but then in a second compared to the other method, which is the variable costing approach. So in this case, we've got Laser Save, that's a recycler of used toner cartridges. They're going to manufacture 100 cartridges for the month, and this is what they have for costs. Their overhead cost per unit is calculated at $20 per unit, and they've sold these at $60. So we need to, under a full absorption costing approach, again, all of the costs are going to be tied to our units. They will go out in cost of goods sold, but also be attached to the inventory that remains in our ending inventory. So let's look at what our product cost is from a full absorption costing approach. We've got our direct materials, direct labor, variable overhead, and then the $20 of fixed overhead causes us to have a total product cost of $43 per unit. And now looking at the income statement approach of having sold the 1,000 toner cartridges at $43 a piece, we've got a cost of goods sold of $43,000, and that gives us a gross profit of 28.33%, gross margin, I should say, of 28.33, and an operating margin of 6.25%. Now let's look at this from a variable costing method, which again, not GAAP compliant. You can't use it to prepare your financial statements. But now we're just going to assign the direct and variable overhead costs to the individual products, but not the fixed overhead. So now we will look at what this has done to our product cost now. So we've got, again, the same initial calculations, but now we're missing that $20 per unit overhead figure. And so what that means is we've got no costs sitting in our ending inventory because in terms of overhead, because we haven't assigned any overhead costs to the inventory. And here is our income statement representation, and look how substantially this changes our gross margin. We are now up to a 60% gross margin as opposed to, I think it was what, 28 maybe? Yes, 28 on the full absorption costing approach. In the end, our operating margin doesn't change, but from a management standpoint, this approach may be more useful for planning. And so to look at what the impact of using one method over the other is, we've got this handy little chart. So if production is more than our sales, then our absorption costing income would actually be more than our variable costing income. If we produce less than we sell, then the opposite occurs. And if we produce exactly what we sell, then the absorption costing income and variable costing income will be the same. Now we've got a few calculations that you just need to kind of take note of at this point. Concepts called sales price variance, sales volumes variance, and overall sales variance. And here are the calculations here. And what this refers to are forecasts. And so if we forecast a sales price and what we ultimately actually have is different than our forecast, we're going to have a variance. And so it could be a favorable, which means we did better than forecasted, or we may have an unfavorable variance, which means we didn't meet our target projections. In this case, we've got the Armour company, and they distribute produce. They expect to sell 20,000 pounds of produce at an average of 20 cents per pound. However, they do better than expected. They do sell 23, although only at 19 cents per pound. So we want to calculate the sales price variance and the sales volume variance, and then the overall sales, and then discuss whether or not it is favorable or unfavorable. So again, plugging these numbers into the calculations, what we were actually able to charge, the 19 cents, versus what we had hoped to charge, the 20 cents per unit, times what we sold, has us unfavorable, or we fell short of our forecast by $230. Now, in terms of volume variance, we sold 23,000. We believed we'd only sell 20, but we thought we were going to sell it at the $20, 20 cents per unit. But despite the fact that, the fact that we sold more, that has us at a more favorable variance. And then overall, if we look at these two factors and we combine those, so we're 230 short here, but 600 over here. Overall, we are 370 positive over what we had forecasted. So even though, as your slide points out, we got a penny lower than we had expected, because we ultimately sold more than we had anticipated, overall that compensated for the decrease in the sales price. So a couple more definitions and calculations here. We've got contribution margin variance, and contribution margin volume variance. So again, slight change on the calculations that we just looked at. And here we're going to look at that variance across two products. So we've got the Birdwell company, and they have their forecasts here. They've got two models of their bird feeders, a regular and a deluxe. One they sell for $10, one they sell for $50. They intend to sell far more of the lower priced bird feeders and obviously fewer of the more expensive priced. So based on the projections, 15,000 they anticipate in sales for the regular, 25,000 for the deluxe, and then they've got the variable expenses. If we subtract the variable expenses from the price, what we're left with is the contribution margin. And just to recap what that means, basically the variable expenses are the costs associated with the actual production of that product. And the contribution margin is what the product can be sold for, and after it covers its own costs to be a product, what then is available in terms of profits on that, to then cover overhead for the company. So it's what basically each product's contribution over and above its own costs is to be able to contribute to overhead. Now, here we are with our actuals. So here's what we sold. We fell slightly short in terms of our regular models, but we excelled in terms of the deluxe models. So where does that leave us? Well, that gives us a $5,000 contribution margin on the regular, $93.75 on the deluxe, so a total of $14,375. And we'll just recap for a second to see where that compared us with the budgeted. So we were under, let me go down here. So calculating this, the overall contribution margin variance between the two products, we exceeded our expectations by $875. So we performed more favorably than we had anticipated. On the other hand, in terms of volume, we fell short by $843.75. So now we want to look and see how we did in terms of this sales mix between our regular and our deluxe brand. This is very wordy calculation. You may want to just pause and take a note on, because we're going to then jump to the next slide and see how our Birdwell company did. So in terms of their regular model, they actually sold 1,250. They had projected selling 1,500. And we're going to multiply that by the budgeted unit contribution margin, subtracted by what we calculated was the average contribution margin. We're going to then do the same thing on the deluxe. And what we find overall is that we performed better than we budgeted at $1,718.75, despite the fact that we sold far fewer of the regular than we had anticipated. Now, if you are a viewer of Shark Tank, these concepts may be something that you've heard referenced when they talk about market share. Now, when a company first starts out and there's no track record in the marketplace, they've got to make some projections about what percentage of the market share do they believe they can attract for themselves. So they, again, make these forecasts, but then we've got to go back and compare their actual performance to their forecasts. So we're going to look at the market share variance as well as the market size variance. And so we're now looking at this across, and this is done by a percentage, so the actual market share of the percentage, and you've got to know basically market-wide what was sold to be able to effectively calculate these figures. But we happen to have this data for the Birdwell company. So we've got in budgeted sales for the entire bird feeder industry of 20,000. And I won't sort of read all of this, but you can go through and see how the budget market share was calculated. And for these folks, they managed to have 10% of the bird feeder market. Whether or not that's good or not, I can't tell you. But now let's look at market share variance, and basically they actually did better than they projected when they conducted their forecasts. Product life cycle, and I'm going to I'm not going to go on to another video because I only have a few slides left for this. So every product's going to have its it's not going to have a flat line of a life cycle if we were to graph it in terms of units sold. A product is initially introduced to the marketplace. Theoretically, it builds in popularity, it reaches a point of maturation, and then perhaps maybe through obsolescence or just because everybody has one and how many spatulas do you need or whatever, then sales start to decline. And so by charting the product life cycle, it helps firms understand where their product is in its relative life cycle and how to sort of anticipate or how to forecast based on where they're at. So in an introductory stage, quite often we're losing money. It's not at all unusual to push products out onto the market where lots of costs have been invested in the initial research and development and production before anything's even been sold. So you're losing right off the bat the day you roll something out onto the shelves. Hopefully, with any luck, popularity begins to increase and you reach a point where you become profitable. You've covered your costs at least. You're beyond your break-even point. As you head further into your growth stage, you kind of reach that maturity point. It starts to level out and then you get a decline. And again, whether that decline has to do with maybe technological obsolescence or somebody's just built something new and better and shinier, or that basically the market's been saturated and, while, paintbrushes were really cool when they first came out, or hammers, how many hammers does somebody buy? And so I'm sure when the hammer first came out, it was like wildly popular and kind of reached its maturity. And now it's important to recognize from a management standpoint what point your product is in and how that will impact your costs as far as, for planning purposes. So we've got it divided into product, learning effect. In other words, how long will it take your people to become efficient at its production, setups, purchasing, and market. And then with each, I won't read this chart, but each stage of growth, it outlines the impact on each of these individual areas by stage of the growth cycle. We can also look at this from an activity-based costing perspective. And so we're looking at this now from unit level, batch level, production level, and facility level costs. And it's, again, change over the various stages of the growth cycle. There are limitations to everything, and certainly ethical considerations with doing forecasting. Obviously, the numbers are only as good as they reflect potential reality. If they're too loosely tied to reality, in other words, somebody's just pulled them out of the air, they're going to be really unhelpful. Often we use past performance. If we have no past performance, then we're really stabbing in the dark, and that makes this really challenging. Sometimes people are incentivized to alter their forecasts because it may be beneficial. So if the sales department forecasts that they can sell 100 widgets, knowing that they can then negotiate a bonus structure based on meeting that target, and anything above that is, they're into bonus land, then they have an incentive to make sure that that bonus target forecast is as low as possible. So achieving the bonus and the additional monetary incentives that come with that are more likely to be achieved. So you've got to be careful when you're entrusting your managers to make these forecasts that they don't have a vested interest in the outcome, because really there's nothing stopping somebody from who is responsible for establishing the bonus structure from setting the sales goals artificially low so that hitting the bonuses will be quite easy. So that is the end of chapter 18.